The aftermath of this crisis was severe, yet it took only about 5 years for the markets to recover from the blow. But the landscape of financial stability has shifted dramatically as we approach the year 2025. This time, it is not just stocks or real estate alone that are suffering. It's all major asset classes simultaneously. Equities, bonds, and real estate are experiencing sharp declines all at once, an emergency that financial historians are now referring to as the bursting of an all-encompassing bubble, often called the everything bubble. When every significant asset class crashes together, the usual refuges, safe investments, disappear, leaving investors with nowhere to hide. Yet, what if I told you that this isn't an entirely new scenario? What if the current situation is eerily reminiscent of the year 1928, just before the onset of the Great Depression, but with a darker twist, because the tools and mechanisms that enabled recovery after 1929 and after 2008 are no longer available. The Federal Reserve, the nation's central bank, cannot simply lower interest rates to zero again. They are already sitting at historic lows, limiting their ability to stimulate the economy. They also cannot print limitless amounts of money, as they have recently done, leading to the worst inflation seen in the past 40 years, eroding purchasing power and destabilizing financial markets. Furthermore, the government cannot step in with massive bailouts to soften the blow, as it is already burdened with an enormous debt, amounting to approximately $36 trillion. This mountain of debt constrains their ability to provide aid or stimulate the economy, leaving the nation in a precarious position. To truly grasp why every key economic indicator is flashing red, why the window for a major crash appears to be narrowly set between November of this year and June of the next, and why the impending collapse threatens to wipe out more wealth than any catastrophic event in human history, one must look at the mathematics behind the crisis, because this is not mere speculation. Understanding why the year 2025 stands apart from previous financial crashes requires recognizing that we are not dealing with just a single bubble. Instead, we are caught in the confluence of triumphantly expanding bubbles, 3 at once, an unprecedented occurrence in financial history. The first bubble involves the stock market. Specifically, the S&P 500 index is currently trading at a price-to-earnings ratio of about 28, which is nearly twice the historical average of approximately 15 to 17. Such overvaluation has historically only happened twice before, once just before the Great Depression in 1929 and once before the dot-com bubble burst in 2000, which saw the Nasdaq lose about 78% of its value. In both these past instances, the markets crashed within mere months of reaching these extreme valuation levels. However, what makes the current situation even more perilous is the extraordinary concentration risk. Today, a mere 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, collectively account for roughly 30% of the entire value of the S&P 500. This means that if any one of these giants experiences a sharp decline or a complete crash, it could trigger a collapse of the entire market, dragging down countless other assets along with it. Such a level of concentration risk has not been seen since 1929, when a small handful of industrial stocks sustained the market just before the inevitable crash. Compared to 2000, when the dot-com bubble burst, the technology sector was heavily inflated, but it represented a smaller fraction of the total market capitalization. Today, the dominance of these 7 megacorporations, particularly Nvidia, illustrates how extreme and fragile the current valuations have become. Nvidia alone exemplifies the insanity of today's market valuations. The company's stock trades at a price-to-earnings ratio surpassing 65, meaning that investors are paying more than $65 for each dollar of profit the company makes. With a total market value exceeding $3 trillion, Nvidia's valuation surpasses the entire German stock exchange, which corresponds with the 4th largest economy in the world. In essence, the current financial climate is characterized by excess, overconcentration, and unsustainable valuations, setting the stage for a crisis of unprecedented severity. The confluence of these factors signals an impending downturn that could surpass any previous global economic collapse, not just by its financial impact, but also by the scope of wealth destruction involved. This situation cannot be described simply as a rational assessment of value. Instead, It resembles a pervasive wave of speculation fueled by the latest craze surrounding artificial intelligence, a phenomenon that eerily echoes the Internet frenzy of 1999. Back then, many believed that the Internet would fundamentally transform every aspect of daily life and commerce. And while that long-term impact proved to be true, the short-term projections regarding stock valuations and market behavior were catastrophically off the mark. Today, a similar pattern is unfolding once again, with artificial intelligence acting as the focal point of inflated expectations and costly overoptimism. What is becoming increasingly apparent is that, at present, we are witnessing a second bubble, this time in real estate, that, in fact, appears to be even more critically overvalued than the housing market bubble that burst in 2008, leading to the collapse of the global financial system. By November of the year 2025, residential property prices in many regions are approximately 50% above the long-term trend when measured against average income levels and rents. To put that into perspective, during the peak of the housing bubble in 2008, home prices were only about 35% above their normal trend. This means that the current overvaluation exceeds that previous bubble by roughly 43%, making the present situation even more alarming. Consider that the housing market collapse in 2008, which necessitated trillions of dollars in bailouts and brought the world's financial system perilously close to failure, was rooted in properties being roughly 35% over their fundamental value. Now, with this new bubble having reached 50% overvaluation, the scale of potential fallout could be even greater. Let that realization settle. For most people, the high prices they see today seem commonplace, as they have persisted for so long that they no longer appear abnormal or unsustainable. However, residential real estate constitutes only one segment of a far broader and deeply troubling picture. Commercial real estate, in particular, is plunging into a severe downturn, with a crisis unfolding in slow motion that is likely to intensify through the years 2025 and 2026. Office buildings across the United States are now vacant by an average of about 45%, largely because remote work arrangements, once considered temporary, have become permanent fixtures in many companies' operational models. For example, in San Francisco alone, the vacancy rate for commercial office space stands at approximately 35%, reflecting a significant oversupply. These properties were largely financed through long-term mortgages when interest rates were around 3%. Today, however, those original loans are maturing, and refinancing at current interest rates, approaching 7 to 9%, is proving problematic. Many of these buildings are no longer worth enough to cover the costs of new debt servicing at these higher interest rates, leading to a rising number of defaults and losses for banks. This situation resembles a cascade of failures, reminiscent of the subprime mortgage crisis of 2008, but this time centered on commercial properties instead of residential dwellings. Adding yet another layer of complexity, the bond market, considered by many as a safe haven during economic downturns, is now experiencing unprecedented turmoil, making the 2025 year unlike any other in recent history. Traditionally, government bonds have been viewed as the safest assets, ideal for preserving capital when equity markets stumble. During the year 1929, even as stocks plummeted by nearly 90%, bonds maintained their integrity. Similarly, during the financial crisis of 2008, U.S. Treasury bonds rallied robustly as investors sought refuge from collapsing stock prices. However, in the current year, 2025, both stocks and bonds are declining simultaneously, a phenomenon that has not been seen before in peacetime markets. The primary culprit is the sheer scale of U.S. government borrowing. The federal debt now exceeds $36 trillion, roughly 125% of the country's gross domestic product. To grasp this figure, imagine the total debt being larger than the entire annual economic output of the nation. This debt level is comparable to what America owed at the end of World War II when, unlike today, the country was largely untouched by war and retained its economic strength. Today, the United States finds itself competing against other nations possessing lower debt burdens and more robust fundamentals, which further complicates the situation. The annual interest payments alone on this enormous debt now surpass $1.2 trillion. making it the single largest expenditure in the federal budget, even eclipsing spending on defense or social security. When interest obligations grow so large that they consume more than a portion of government revenue, policymakers are faced with only three possible options: drastically reduce spending, which could trigger a recession, significantly raise taxes, risking economic slowdown, or resort to printing money to pay debts, which would inevitably spark inflation. This confluence of bubbles in housing, commercial real estate, and government bonds paints a picture of an economy under strain, where the foundational assumptions of safety, stability, and rational valuation are being severely challenged. The coming years are poised to test the resilience of financial systems worldwide, revealing whether these inflated markets will deflate in a controlled manner or trigger a deeper, more widespread crisis. All three scenarios point toward an inevitable economic crisis, with no viable route to avoid the impending turmoil. When the scale of interest payments alone matches the entire gross domestic product of a nation like Mexico, it signals a profound and dangerous imbalance in the global financial system. This situation exemplifies what is often referred to as the so-called everything bubble. In recent times, stock valuations have soared to levels that have only been observed twice before in history, both instances preceding major market crashes. Meanwhile, the real estate sector is currently overvalued to an even greater degree than during the infamous housing bubble of 2008. At the same time, bonds, a traditionally considered safe haven for investors, are collapsing under the enormous burden of unmanageable government debt, which is fundamentally unsustainable. The parallels between the economic landscape of 2025 and that of 1929 are so strikingly precise that it feels as though history is repeating itself in a painfully exact, frame-by-frame manner. Back in 1929, stock market valuations reached unprecedented heights, with the price-to-earnings ratio of the Dow Jones Industrial Average soaring to 33, an extraordinary figure that stood far above any historical precedents. In the current year, 2025, the S&P 500 index is trading at approximately 28 times its earnings, echoing those historic extremes. During the late 20s, the general public was swept up in the belief that new technological advances, most notably electricity, the radio, and the automobile, had engendered a fundamentally transformed economy, one immune to traditional valuation metrics. The phrase, "this time is different," became a common refrain among investors, as they convinced themselves that old rules no longer applied. The current era is similarly convinced that artificial intelligence constitutes a revolutionary technology capable of rendering conventional economic principles obsolete. Looking back to 1929, margin debt, funds borrowed to purchase stocks, had reached an all-time high, with investors ranging from medical doctors to young shoe-shine boys leveraging themselves heavily to participate in the exuberant market. Rumors circulated widely that ordinary, everyday people suddenly became wealthy overnight through reckless stock speculation, fostering a sense of false security. Today, in 2025, margin debt relative to gross domestic product is at comparable alarming levels, but the scale of leverage has grown far beyond traditional borrowing limits. Retail investors are increasingly engaging in options trading with borrowed money, and some are even using credit cards to buy stocks. Corporations, driven by the desire to boost share prices, are borrowing substantial sums to repurchase their own shares at inflated prices, further inflating the bubble. Leverage has seeped into nearly every corner of the financial system, hidden within complex derivatives, options, and debt structures that most individuals do not fully understand or even recognize, making the entire system dangerously fragile. The issue of wealth inequality in 1929 had already escalated to extreme levels, with the wealthiest 1% controlling roughly 25% of total income. This stark concentration meant that the economy's stability was heavily reliant on a small handful of affluent individuals whose continued spending and investment fueled the economic engine. Once these top earners or investors withdrew their support, the entire system was vulnerable to collapse. Fast forward to 2025, and the disparity has become even more pronounced. The wealthiest 1% now own around 32% of total wealth, a higher share than during the Great Depression, and the stability of the economy hinges on the spending and investment behaviors of the top 10%. This group controls approximately 70% of consumer spending. If they halt their expenditures, perhaps triggered by a sharp decline in stock portfolios, the resulting drop in consumer demand could plunge the economy into a downward spiral of contraction and crisis. What makes the current situation even more perilous than that of 1929 is the significant difference in how widespread stock ownership has become among ordinary Americans. During the late 20s, only about 10% of households owned stocks, which meant that the vast majority, around 90%, were not directly affected when the market crashed. Their initial financial stability remained intact because they lacked significant investments in stocks, though many suffered later through rising unemployment and falling prices. In contrast, in the year 2025, approximately 58% of American households own stocks, either directly or through retirement accounts such as 401(k) and individual retirement accounts. This high level of ownership means that when the market inevitably crashes, it will immediately and directly erase the retirement savings of more than half of the population, devastating millions by stripping away the financial security they believed was securely built up over years. In essence, while the stock market crash of 1929 spared most ordinary Americans from immediate loss due to limited direct holdings, the modern scenario exposes a vast majority of households to devastating personal financial consequences from a sudden collapse. These intertwined factors underscore just how precariously balanced the current economic state is, with vulnerabilities reminiscent of the most catastrophic financial crises in history, now intensified by greater levels of overvaluation, leveraged positions, and widespread wealth concentration. The financial system today, much like it was nearly 115 years ago, faces a precarious vulnerability due to the absence of reliable safeguards and buffers that could mitigate potential crises. Without sufficient insurance or reserve buffers, every institution and individual is exposed to immediate and severe repercussions whenever instability strikes. To understand this risk more clearly, we can look back at the year 1929, an era characterized by a fragmented banking sector consisting of countless small-scale banks operating independently, without the backing of federal deposit insurance. When the economic downturn hit in late October of that year, these banks failed en masse, primarily because depositors, terrified by the collapsing economy, rushed to withdraw their funds en masse. The absence of federal deposit guarantees meant that countless ordinary people saw their life savings wiped out in a matter of days, fueling widespread panic and forcing the government into an emergency response. Fast forward to the year 2025, and we find ourselves in a different landscape, at least in appearance, where the Federal Deposit Insurance Corporation, or FDIC, stands as the primary safety net for depositors. Currently, this agency claims to protect deposits up to $250,000 per individual account. While this sounds reassuring, the reality reveals a stark imbalance. The FDIC's claims reserve amounts to roughly $125 billion, an amount that seems substantial until contrasted against the roughly $10 trillion in total bank deposits it insures. This means that in a hypothetical scenario where multiple, or even just a few of the largest banks failed simultaneously, the FDIC's funds would be utterly inadequate. To meet the obligations of compensating depositors fully, the government would be compelled to print trillions of dollars out of thin air. Such a massive infusion of money would inevitably lead to runaway inflation, eroding the value of the currency and destabilizing the economy. It's a dilemma. Depositors could lose their savings directly through bank insolvencies or indirectly through the devaluation of money caused by inflation. In the end, they are essentially faced with a choice of losing their funds in one of two ways, either momentarily through bank failures or gradually through inflationary depreciation. It is a bitter pill that remains unchanged over the decades. As the stark reality persists, no matter which route is taken, the risk is unavoidable, and the outcome is essentially the same. Meanwhile, the Federal Reserve, established just over a century ago in 1913, during a period of relative confidence and limited scope, was once seen as a credible and capable institution with significant room to maneuver in times of crisis. At that time, The monetary authority had not yet worn down public trust through decades of unpredictable booms and busts. Moving into 2025, we observe that subprime lending has not vanished, but has simply adapted in form and nomenclature. Today, subprime-like lending manifests everywhere, though it is often referred to by different names. For example, auto loans stretch over 84 months at high interest rates to individuals with poor or no credit histories, while credit card debt has reached record levels, with the average interest rates exceeding 21%. Student loans have ballooned to a staggering sum of at least $1.77 trillion, a figure that will never be fully recovered or repaid. Corporate debt has also significantly increased, from around $2 trillion in 2008 to over $10 trillion today, fueling borrowing at historically low rates to fund stock buybacks and other speculative activities. This widespread leverage resembles the pre-Minus 2008 system, but extends beyond housing and mortgage securities. The systemic risk today is dispersed across several types of debt, many of which are similarly built on questionable fundamentals. Back in 2008, the leverage in banks such as Lehman Brothers soared to 30-1, meaning they operated with 30 times as many assets as they had capital. Such levels of leverage meant that even a modest decline in asset values, say 3%, could wipe out the firm entirely. When Lehman Brothers ultimately collapsed, it set off a chain reaction that plunged the global economy into its deepest downturn since the 1930s. Looking ahead, the contours of the coming financial storm in 2025 and 2026 resemble the threats faced before the 1908 crisis, but with greater complexity and interconnectedness. The familiar pattern of excessive borrowing, inflated asset bubbles, and over-leveraged financial institutions threaten to trigger another systemic upheaval, one that could dwarf the crises of recent decades. Leverage, deceptive in its reach, is no longer confined to a single sector or niche. Instead, it has permeated the entire financial ecosystem, manifesting in countless interconnected forms. Currently, the global derivatives market boasts a staggering notional value exceeding $600 trillion, an amount more than 10 times the total output of the entire world economy measured by gross domestic product. Most of these intricate contracts comprise interest rate swaps and credit default swaps, financial instruments that, while seemingly just parts of sophisticated risk management, possess the potential to spiral out of control with alarming speed. If interest rates were to shift dramatically, or if a major corporation were to default on its obligations, these derivatives could suddenly unravel, triggering a chain reaction of collapses across the system. Owing to the high degree of interconnectedness among financial institutions through these derivatives, one failure could rapidly ignite a cascade of financial contagions, each failure reinforcing the next, creating an unstoppable domino effect. Reflecting on the financial crisis of 2008, it's evident that the Federal Reserve was equipped with a powerful arsenal of tools to combat widespread turmoil. At that time, interest rates were set at roughly 5.25%, affording the central bank significant leeway to lower them further, potentially all the way down to zero, in an effort to stimulate economic activity. Such reductions aim to encourage borrowing and spending, alleviating the downward spiral and helping to stabilize the fragile economy. Beyond adjusting interest rates, the Fed employed a strategy called quantitative easing, buying trillions of dollars worth of Treasury securities and mortgage-backed assets to flood the financial system with liquidity. This unprecedented move expanded the Fed's balance sheet from approximately $800 billion before the crisis to nearly $4 trillion by 2014. While these measures effectively prevented a total economic collapse and kept the financial system afloat, they also laid the groundwork for the bubbles and distortions we are grappling with today. Fast forwarding to the year 2025, it's clear that the economic landscape has shifted dramatically. Interest rates are already relatively low, leaving the Federal Reserve with minimal space to maneuver downward without risking reigniting inflation. Any drastic cut in rates could spur a renewed surge in prices, a perilous prospect given the recent history of inflation running at its fastest pace in 4 decades, from 2021 to 2023. Such inflationary waves demonstrated clearly that limitless money printing undermines the very stability of a currency's purchasing power, causing inflation to spiral out of control. Conversely, if the Fed chooses not to lower interest rates further, the economy might be left to plunge into a severe downturn, potentially a depression, with damaging consequences for millions. Quantitative easing, another vital tool, faces similar constraints. After multiple rounds of asset purchases following the 2008 crisis and during the COVID pandemic, the Fed's balance sheet surpasses $7 trillion, a level that raises questions about sustainability and limits further expansion. Although printing more money is theoretically still possible, today's awareness that excessive money creation implies inflation has made policymakers cautious. In the years following 2021, the inflation surge proved conclusively that printing unlimited amounts of money significantly erodes the currency's intrinsic value, leaving the central bank trapped between two dangerous choices: risking hyperinflation if it continues to expand the money supply, or risking deflation and economic contraction if it refrains. The capacity of the government to intervene through bailouts has also been eroded significantly since 2008. Back then, federal debt was roughly 67% of gross domestic product, allowing the government to borrow substantial sums, around $700 billion through the Troubled Asset Relief Program, TARP, to rescue struggling banks by purchasing toxic assets. Additional programs brought total bailouts close to $2 trillion. Although politically unpalatable to some, these measures were financially manageable because the country's borrowing capacity was still ample, with manageable debt levels by historical standards. Now, in 2025, the situation has reversed profoundly. Federal debt exceeds 125% of GDP, with deficits soaring into the trillions of dollars annually. The government no longer possesses the financial room to borrow another $2 trillion to bail out failing banks and corporations, and any attempt to do so could cause bond markets to panic, leading interest rates to spike higher still. Such an increase would make debt servicing unsustainable, possibly collapsing the entire system. The rescue strategies that proved effective in 2008 are simply unavailable now, due to the overwhelming size of debt and the diminished capacity to borrow. Adding to the gravity of the situation is the complex international dimension that further complicates the outlook for 2025, making the scenario even more dire than in 2008. During that earlier period, China was experiencing rapid economic growth, which helped buoy the global economy out of recession by stimulating domestic demand and purchasing commodities from around the world. These interconnected dynamics provided a crucial counterbalance, shielding the global financial system from even worse impacts during turbulent times. However, in the current moment, this help may no longer be readily available or as effective, worsening the overall economic outlook and diminishing the prospects for a swift recovery. Europe, despite feeling the tremors of the ongoing financial and geopolitical upheavals, did not fall into the same deep debt trap that has ensnared the United States. While the crisis affected many regions, Europe's position remained somewhat different due to coordinated efforts and a degree of resilience. Across the globe, nations came together through the G20 framework, orchestrating collective stimulus measures intended to stabilize their economies in uncertain times. Yet, as 2025 unfolds, new troubles emerge elsewhere. China is now facing its own economic turmoil, with a collapsing property market that has sent shockwaves through its financial system. At the same time, the sprawling local government debts, so vast that they have surpassed $13 trillion, pose an enormous challenge to the country's fiscal stability. Compounding these issues, China is grappling with a demographic crisis, as its population continues to shrink due to aging and lower birth rates, threatening long-term economic growth and stability. Meanwhile, Europe wrestles with its own set of complex challenges: an energy crisis tightening its grip, a declining population that impacts labor and growth prospects, and increasing political fragmentation that hampers unified decision-making. The lack of a dominant global economy in a strong position to steer the world's recovery underscores the precariousness of the current situation. Geopolitical tensions among major powers further diminish prospects for international cooperation, meaning that when the next crisis fully manifests, nations are more likely to prioritize their own survival above all else, rather than working collaboratively to find solutions. One of the most historically reliable indicators of impending economic downturns over the past 7 decades has been the behavior of the yield curve on government bonds. Specifically, when the yields on short-term bonds rise higher than those on long-term bonds, known as an inverted yield curve. This pattern has consistently predicted recession since the year 1950. Notably, there have been no false signals from this indicator. The yield curve inverted in July of 2022 and remained in that inverted state for approximately 27 months before finally returning to a normal upward sloping shape in September of 2024. Extensive historical data indicates that economic recessions almost invariably begin within 3 to 12 months after the yield curve shifts back to a normal, non-inverted configuration, not while it remains inverted. Given this pattern, the current window of heightened risk spans from October of 2024 through September of 2025. This is the period during which the indicator consistently signals that a recession is imminent. The warning is precise and unwavering. The signals do not lie. Adding to the concern is the current level of consumer debt, so high that the scale makes the financial crisis of 2008 seem almost manageable by comparison. Today, the total credit card debt in the United States has surpassed $1.14 trillion, setting a fresh historic record in nominal terms. On average, each household carries around $6,800 in credit card balances, with interest rates typically ranging from 21 to 28%. Furthermore, the percentage of consumers falling behind on their payments, designated as delinquencies of 90 days or more, has climbed back to levels not observed since 2011. This deterioration in consumer credit health directly impacts the broader economy, considering that consumer spending comprises approximately 68% of the entire United States economic activity. When borrowing capacity diminishes and households are forced to prioritize paying down debt instead of spending, economic contraction becomes inevitable. We are now reaching a plateau where consumers are effectively at their maximum borrowing capacity, unable to sustain the spending needed to keep the economy expanding. The critical financial engine grinds to a halt. In addition to consumer debt, the commercial real estate sector is quietly deteriorating. Although the decline appears gradual and slow-moving at first, it is poised for a sharp acceleration through the years 2025 and 2026. More than $2 trillion worth of commercial mortgages are set to mature and require refinancing during this period. These loans were initially secured when interest rates hovered around 3%, a rate that made many projects financially viable. Today, with interest rates now fluctuating between 7 and 9%, the original assumptions about cash flow and property values no longer hold. Many buildings, particularly in prime markets, were barely sustaining themselves at the lower interest rates. At the current elevated rates, their financial models become unsustainable, often becoming outright bankruptcies in the making. As a result, property values have plummeted, down by roughly 40 to 60% in numerous markets, since buyers now understand that existing debt levels cannot be supported at current interest rates. When owners are unable to refinance their mortgages, they face foreclosure. In many cases, lenders will seize the properties, force owners to default, and take possession of the assets. This process will cause hundreds of regional banks holding these distressed mortgages to face enormous losses, enough to deplete their capital reserves significantly. The failures of regional banks in the year 2023 served as stark warning signs, yet many failed to heed these alerts. One of the largest bank collapses in American history happened in March of that year, when Silicon Valley Bank failed in a sudden and dramatic collapse. That event was followed shortly thereafter by the failure of Signature Bank within the same week. The crisis continued to deepen in May when First Republic Bank also failed, eventually being absorbed by J.P. Morgan Chase at a massive loss, which the Federal Deposit Insurance Corporation, FDIC, had to cover. This sequence of failures underscored the fragility of the financial system, particularly within regional banking institutions heavily exposed to emerging real estate and credit crises. In early January of 2024, the financial stability of New York Community Bank was hanging precariously, teetering on the very brink of collapse. This dramatic deterioration in the bank's condition occurred despite the fact that the economy was not in a recessionary phase at that time. Typically, such failures tend to accelerate when economic downturns are underway and as the inevitable recession arrives, bringing with it an increase in loan defaults. Dozens more regional banks across the country are expected to face similar fates. The impact on the banking system could be swift and severe, given that the Federal Deposit Insurance Corporation, commonly known as the FDIC, would exhaust its insurance fund, which is currently set at a staggering $125 billion, within a matter of weeks. Once that reserve is drained, the government would likely be compelled to resort to printing more money to ensure the safety of depositors' funds. Such a move would inevitably lead to the devaluation of the currency, undermining its worth and potentially triggering inflationary pressures. A unique source of vulnerability in today's financial environment stems from the unusually high concentration of market value held within a small handful of stocks, often referred to as the Magnificent Seven. These seven technology giants, namely Apple, Microsoft, Nvidia, Amazon, Alphabet, the parent company of Google, Meta, formerly Facebook, and Tesla, collectively account for roughly 30% of the entire market capitalization of the Standard & Poor's 500 index. To put that into perspective, nearly a third of one of the world's most widely followed benchmarks is composed of just these seven companies. Among them, Nvidia stands out prominently. With a current price-to-earnings ratio exceeding 65, it alone constitutes approximately 7% of the entire index's value. This means that if Nvidia were to deliver disappointing earnings reports, or if the speculative fervor surrounding artificial intelligence, AI, were to fade significantly, its stock could easily plunge by 50 to 70%. Given its weight in the index, such a decline would almost certainly drag the entire market downward with it, creating a domino effect that could accelerate swiftly. This level of concentration risk is truly unprecedented in modern market history. When a market downturn does occur, these seven stocks are destined to lead the decline, and because they make up such a substantial share of the total market, the resulting crash would be both rapid and intense, surpassing any downturns observed in previous eras. Meanwhile, warning signs of trouble are emerging from the world of corporate insiders, those executives and key shareholders who possess privileged, non-public information regarding their company's true financial health. The volume of insider selling activity has reached levels that historically have foreshadowed major market corrections. These insiders, who see the authentic earnings figures, real business pipelines, and underlying issues months or even years before ordinary investors, typically start divesting their holdings once they become convinced that current valuation levels are unsustainable. The actions of some of the most prominent business leaders underscore this trend. For example, Jeff Bezos, the founder of Amazon, sold over $13 billion worth of his Amazon stock during the years 2024 and 2025. Similarly, Mark Zuckerberg has sold billions of dollars worth of Meta stock, and Nvidia's corporate executives, even as their stocks soared to new heights, were quietly selling off shares. This pattern of large-scale insider sales echoes what was observed in the historic crashes of 1929 and 2000. Professionals with access to private, sensitive information are often the first to recognize when market valuations are irrationally high, and they tend to exit before the wave of panic hits. In addition, the legendary investor Warren Buffett, widely regarded as the most successful investor in history, is currently holding a cash position larger than at any previous point in his career. Berkshire Hathaway, his conglomerate, now holds more than $325 billion in cash, an all-time high, both in absolute terms and relative to the firm's total assets. Buffett has been gradually reducing his holdings in stocks, including trimming his enormous position in Apple, while simultaneously increasing his holdings in U.S. Treasury bills. When asked about these capital allocations, Buffett explained that he perceives stock valuations to be dangerously high and, as a result, he finds it difficult to identify investments that offer attractive risk-adjusted returns. His own preferred measure, known as the Buffett indicator, which is calculated by dividing the total market value of all publicly traded stocks by the nation's gross domestic product, stands at an eye-watering 185%. Financial experts generally consider a reading above 120% to be a strong warning sign of overvaluation, and with the indicator almost nearing twice that level, the message could not be clearer. The world's most renowned investor appears to be sitting patiently, in cash, patiently waiting for the inevitable market correction because he is confident that it is imminent. Turning to the labor market, recent trends reveal that unemployment, which had fallen to a remarkably low 3.4% in early 2023, has been gradually climbing and is expected to reach 4.1% by late October of 2025. While an unemployment rate of just over 4% still remains relatively low by historical standards, it is the upward trajectory that raises concern. Such an increase in joblessness indicates a potential weakening of economic momentum and could serve as an early warning signal of upcoming slowdown or recession. Counterintuitively, the significance of this change is often greater than the absolute figure itself because a rising unemployment rate can signal the beginning of broader economic distress. Economists and analysts refer to a rule developed by Claudius Sohm, an esteemed economist, which indicates that when the 3-month moving average of unemployment begins to rise, regardless of whether it remains below certain thresholds, it often presages a period of economic contraction. This rule suggests that early signs of a turn in employment trends can foreshadow more profound economic shifts ahead. In summary, the current financial landscape is characterized by growing vulnerabilities, unprecedented concentration of market power among a handful of stocks, suspicious levels of insider selling, record-high cash hoards by the world's most successful investor, and a rising unemployment trend, all signaling that caution and preparedness for potential upheaval are more necessary than ever. When the difference between the current economic indicators and their lowest levels during the past 12 months reaches just 5 percentage points, it signals that the economy is firmly in a state of recession. This specific rule, which has proven to be remarkably accurate, has successfully predicted every recession occurring since the year 1970 without ever producing a false alarm. As of October in the year 2020, our current economic conditions are approaching, or may have already reached, the critical threshold that activates this well-established recession indicator. One of the key signals involved in this assessment is the pattern observed in unemployment rates. They are steadily climbing. Once the unemployment rate begins its upward trajectory, it often accelerates rapidly. This acceleration occurs because when people lose their jobs, they are forced to seek new employment, leading to layoffs in other sectors, which then creates a feedback loop of rising unemployment. For example, the delinquency rates on auto loans have surged to levels not encountered since the financial crisis of 2008. Approximately 7.5% of auto loans now exceed 90 days of missed payments, marking the highest delinquency rates recorded since the year 2009. Furthermore, the average monthly payment required for a new car loan has exceeded $740, which is a significant financial burden. Loan periods have expanded dramatically, stretching out to 84 months, meaning individuals are committing to payments over the course of 7 full years. This pattern of lending resembles subprime borrowing, but it is often disguised by different terminology or marketing strategies. Essentially, individuals who do not have sufficient income or financial stability to afford a vehicle are being granted loans that they are unlikely to repay fully. When these borrowers default, the repercussions extend beyond the loss to the lender. They significantly impair the borrower's ability to commute to work, thereby increasing the likelihood of job loss as well. This process acts as a leading indicator of broader financial distress within the consumer sector. The situation with student loans further emphasizes this trend. Since October 2023, when borrowers resumed their payments after a 3-year suspension caused by the pandemic, delinquency rates on student loans have surged sharply. The total amount of outstanding student debt now stands at an astonishing $177 trillion across approximately 43 million borrowers. Many of these borrowers choose to default on their loans rather than attempt to resume payments, fully aware that the colossal debt they owe is virtually impossible to repay in full. The consequence of this widespread defaulting is a drain of over $100 billion each year from the broader economy. Instead of investing in homes, starting families, or purchasing goods and services, young adults are immobilized by their crushing debt burdens. This generation, which should ideally be a driving force behind economic growth, is instead ensnared in a cycle of debt that yields little to no tangible economic returns, servicing debt rather than generating wealth. Looking ahead to 2025, the geopolitical landscape presents numerous risks that could significantly destabilize the global economy. Ongoing conflicts in Ukraine and the Middle East continue to threaten regional stability. Meanwhile, the persistent threat of China initiating an invasion of Taiwan looms as a potential flashpoint. Adding to these concerns is the ongoing trend of countries fragmenting global trade into competing blocs, each pursuing their own economic and strategic interests. Any escalation in these tensions could precipitate disruptions in energy supplies, shortages of essential foodstuffs, or interruptions to critical supply chains, each of which would have serious repercussions. A severe spike in oil prices, reminiscent of the shocks experienced during the 1970s, could trigger stagflation, a dangerous economic condition characterized by simultaneous inflation and recession, posing a challenge even more difficult to manage than a typical downturn. Uncertainty tends to be detrimental to market stability, and in 2025, geopolitical tensions are at levels reminiscent of the most tumultuous periods since the 1970s. Signs of stress are already emerging in the commercial real estate sector. Defaults among major institutional owners are beginning to surface. For instance, in the year 2024, Brookfield Asset Management failed to meet its debt obligations on two prominent office towers located in Los Angeles. Likewise, Blackstone, which holds the position of being the largest owner of commercial real estate in the world, has encountered considerable difficulties due to increasing requests from investors seeking to withdraw their funds. These investors are among the most sophisticated and financially savvy, smart money, who are now walking away from properties because the current financial calculations no longer work at prevailing interest rates. When such major players start defaulting, it serves as a clear warning that fundamental economic conditions have broken down. The defaults are anticipated to cascade throughout the years 2025 and 2026 as more mortgages reach their due dates, resulting in significant losses for banks, an increasing number of defaults, and ultimately, the potential failure of banking institutions. This crisis will not arrive with a sudden, unmistakable starting point that everyone recognizes immediately. Instead, it will likely begin with a seemingly manageable incident or problem, something small or localized, that gradually escalates into a broader financial upheaval. A sudden or unexpected decline in a major technology company's earnings, a larger than anticipated failure of a regional bank, an intensification of a geopolitical conflict, or a breakdown in negotiations over debt restructuring can serve as the initial spark. However, the particular nature of this trigger is often of secondary importance because the entire financial system has become so fragile that any significant shock, no matter how small, can ignite a chain reaction. What truly matters is what unfolds in the aftermath. The way in which this initial failure sets off a series of subsequent disturbances, each one amplifying the next, ultimately causing the entire financial network to plunge into chaos and chaos-like conditions. For example, if a company like NVIDIA or one of the so-called Magnificent Seven tech giants disappoints expectations with weaker earnings or offers subdued forecasts for future growth, cutting-edge algorithmic trading programs jump into action almost instantaneously. These highly automated trading systems trigger massive sell-offs within moments, often resulting in the stock price plummeting by 10 or even 15% in just a single trading day. Since NVIDIA alone comprises roughly 7% of the Standard & Poor's 500 index, such a decline would translate into an approximate point drop of about 0.7% in the overall market. While that might seem manageable at first glance, the real danger lies in the psychological impact that follows. When the core narrative that has driven valuations, particularly the story surrounding artificial intelligence, begins to unravel, investors' confidence erodes rapidly. This skepticism cascades into broader doubts about the valuations of all major tech companies, including giants like Microsoft, Apple, Amazon, Google, Meta, and Tesla. As the collective sentiment weakens, these titans begin to see their stock prices decline as well. Over the course of just a few days, the value of the so-called Magnificent Seven could fall by 20 or even 30%, dragging the entire stock market down by somewhere between 6 and 9%. Such sharp declines trigger margin calls, demands from brokers for investors to put up additional collateral when their positions are underwater. Margin calls act as a catalyst for an accelerated downward spiral, transforming a mere decline into a full-blown market crash. Investors who have purchased stocks on borrowed money, leveraging their investments, find themselves at risk of being forced to sell off their holdings when prices fall. When these holdings are sold, prices decline further, prompting more margin calls. This cycle feeds on itself, creating a vicious circle that can accelerate rapidly. The stock market crash of 1929 is often cited as a prime example of this terrifying mechanism in action, an unstoppable downward spiral propelled by failing margin requirements. Fast forward to the year 2025, and the situation appears eerily similar. Today, the proportion of margin debt relative to the overall market value is comparable to the levels seen during the catastrophic crash of 1929. When the selling pressure finally becomes overwhelming, it is expected to be swift and relentless. Large institutional investors, managers of trillions of dollars in pension funds, university endowments, and sovereign wealth funds, operate under risk management protocols that mandate the liquidation of assets once market declines surpass certain predetermined thresholds. These rules are not driven by emotion but are embedded into automated systems designed to minimize potential losses. Consequently, when stock prices dip by 20% or more, these institutional mechanisms activate and compel rapid mass selling. This institutional withdrawal adds significantly to the downward pressure, compounding the initial decline. During the first month of a serious market downturn, stock prices could plausibly tumble by 30 to 40%, propelled by a combination of retail panic and liquidations by large investors, all happening nearly simultaneously. As assets diminish in value, the crisis does not stay confined to stocks alone. It begins to spill over into bonds. Investors, frightened by the turmoil and seeking safety, aim to move their assets into what they perceive as secure holdings. Yet, by 2025, even U.S. Treasury bonds, traditionally considered the safest asset, are not immune. This is because the government faces enormous fiscal challenges, needing to issue trillions of dollars more to cover rising deficits and refinance maturing debt. If a sudden rush to safety coincides with the government's bond issuance, interest rates could skyrocket as bond prices fall sharply, creating a perilous feedback loop. Higher interest rates increase the cost of servicing the national debt, prompting the government to borrow even more, issuing additional bonds just as investors are reluctant to buy them at higher yields. This vicious cycle, often called a doom loop, tends to escalate, ultimately forcing countries into default or sparking currency collapse driven by runaway inflation. Meanwhile, the housing market, which has already been subdued for some time, comes to a complete standstill as potential buyers withdraw, unwilling to accept lower prices, and sellers refuse to lower their asking prices. The entire economic landscape, even sectors once thought to be relatively stable, becomes mired in uncertainty, with contraction and stagnation spreading outward like ripples across a stagnant pond. Homes that have been listed on the market for extended periods often remain unsold for many months, sometimes stretching into half a year or longer, without attracting any suitable offers. When homeowners find themselves in urgent need to sell, whether due to job relocations, financial difficulties, or other pressing circumstances, they are often compelled to reduce their asking prices to encourage buyership. These reductions, although necessary for closing sales, have a ripple effect throughout the housing market. As property prices are lowered, they establish new, lower reference points, often referred to as comparable sales or comps, which, in turn, influence the valuation of other homes in the same area. This chain reaction causes an overall decline in home values across entire neighborhoods or markets. Over time, these successive price reductions can accumulate to cause a significant drop in home prices, with estimates suggesting that in a span of roughly half a year, prices could decrease by as much as 20 to 30% from their previous peak values. Looking at a longer horizon of about 1 year, especially in overheated or overvalued markets such as Austin, Phoenix, Boise, as well as certain regions of California and Florida, declines of approximately 40 to 50% from the heights reached during the peak of the boom are entirely within the realm of possibility. Homeowners who purchased properties within the past 3 years often find themselves in a difficult situation, owing more on their mortgages than their homes are currently worth. This situation is commonly called being underwater or upside down, and it presents a serious financial challenge for those affected. Meanwhile, the commercial real estate sector faces its own grave crisis. Defaults on commercial property loans are increasing rapidly as property owners come to terms with the reality that refinancing their maturing loans is no longer feasible, especially when property values have plummeted. Many of these owners, unable to meet their financial obligations, cease making mortgage payments altogether, returning the keys to their lenders, most often regional banks, in what is known as a foreclosure or a walk-away. The bank then takes possession of the property, which in many cases is now worth between 40 to 60% less than the amount owed on the original loan, resulting in what is called a realized loss. When banks sustain such significant losses across numerous commercial real estate loans, their overall capital reserves are severely depleted. Banks are required by regulators to maintain certain minimum capital ratios, buffers that ensure their stability and ability to absorb losses. When these ratios dip below mandated thresholds due to mounting losses, regulatory authorities intervene by closing down troubled banks. The banking failures of the year 2008 serve as a stark reminder. Over a period of 5 years, close to 470 banks failed in that crisis, an unprecedented number. In a future financial downturn, we could witness similar or even higher numbers of bank failures, but within a shorter span of time, amplifying the economic turmoil. The collapse of multiple banks naturally triggers a wave of panic among depositors, who become anxious about the safety of their savings. This apprehension leads to a surge of withdrawal requests, what is traditionally called a bank run, as individuals rush to pull their money out of banks they perceive as potentially at risk. Even financially solid banks are not immune, because they typically lend out most of their depositors' funds or invest in securities, leaving them with limited cash reserves on hand. When a bank run begins, the affected bank faces the urgent necessity of liquidating assets, often at sharply discounted prices, fire sale prices, to raise enough cash to meet withdrawal demands. This forced selling results in losses that can be substantial enough to push a bank that was previously solvent into insolvency, threatening the stability of the entire financial system. To prevent a total collapse of the banking system, the government's financial authorities, such as the Federal Deposit Insurance Corporation, FDIC, step in with safety nets, ensuring deposits up to a certain limit, currently around $125 billion. However, this insurance fund is nowhere near sufficient to cover the losses that would stem from multiple large bank failures occurring simultaneously or in rapid succession. Consequently, the government often resorts to printing additional money to support and bail out troubled banks, covering depositors' funds directly. While such actions may provide temporary relief, they also trigger inflation because increasing the money supply reduces its value. Over time, excessive inflation can erode the currency's purchasing power and destabilize the economy. As the financial instability intensifies, the repercussions extend into the labor market. Companies experiencing falling revenues and mounting economic uncertainty respond by implementing layoffs, cutting jobs to reduce costs. Technology firms, which often expanded significantly during the boom years, start shedding 10 to 20% of their employees as part of restructuring efforts. Financial services companies, heavily exposed to volatile markets, are compelled to reduce their staff as well. Retailers and consumer discretionary businesses face dwindling consumer spending, leading them to close stores and eliminate positions altogether. These cascading effects can cause unemployment rates to climb rapidly. Within just 3 months from the onset of the crisis, unemployment could increase from a stable 4% to around 7 or 8%. As conditions worsen over 6 months, hitting a realistic 10%, the employment landscape becomes increasingly dire. A year into the downturn, unemployment might reach anywhere from 12 to 15%, with multiple failures across industries amplifying economic suffering. The Federal Reserve faces an extremely challenging dilemma. To stabilize financial markets and support economic activity, it could choose to cut interest rates substantially and implement measures like quantitative easing, pumping liquidity into the system by purchasing securities. However, these strategies have their pitfalls. While they may temporarily alleviate stresses in the markets, they risk reigniting inflation, which the economy is only beginning to tame after previous surges, such as those experienced between 2021 and 2023, when inflation soared to approximately 9%, drastically eroding consumers' purchasing power. If the Federal Reserve proceeds to print trillions more dollars to support the economy during times of crisis, the value of the dollar could collapse, igniting an inflationary spike even more severe than past episodes. In such a scenario, the economic and monetary damage could be profound, leaving recovery more difficult and prolonging the financial instability for many years to come. The economic upheaval looming on the horizon presents a stark choice. Either society allows the impending crash to unfold, leading inevitably to a period marked by severe Depression-era unemployment rates coupled with a decade or more of stagnation in economic growth, or it tries to intervene, although the tools at policymakers' disposal are no longer effective. The reality is that there exists no viable middle ground. Measures that proved useful in the financial crisis of 2008, such as large-scale bailouts, quantitative easing, or aggressive rate cuts, are essentially useless in the year 2025 because they have already been extensively employed, and their consequences are now well understood across financial markets. As a result, the current situation is fundamentally different, and the options to stabilize the economy are limited, if not non-existent. For the average American saver, particularly those who depend on their retirement savings typically accumulated in a 401(k) plan or an individual retirement account, a sharp decline in their savings, potentially 50 to 60 or even 70%, would be devastating. Such a decline in their retirement accounts would impact individuals more profoundly than mere numbers on a statement. It would threaten their entire financial security. Imagine someone who took 30 years to diligently save and built a nest egg of approximately $600,000. With the coming market downturn, their nest egg could plummet to just around $200,000 or less. This isn't simply a market correction. It's akin to the dismantling of their entire financial future. Many will find themselves unable to afford retirement as planned, forcing them to delay their retirement by 10 or even 15 additional years, assuming they are able to continue working and retain their jobs through the forthcoming recession. The consequences for those already in retirement are even more dire. Relying on annual withdrawals from their portfolios to cover living expenses, these individuals will be compelled to sell assets at their lowest points, effectively locking in real losses that could take decades, or perhaps longer, to recover. The psychological toll of witnessing their lifelong savings evaporate will be profound and enduring. They may experience feelings of despair, loss, and uncertainty that linger long after the markets eventually recover, or, in many cases, if they recover at all. Reflecting on the past, during the financial crisis of 2008, retirement savings suffered similar drops but managed to rebound within approximately 5.5 years. Those investors who held steady and persevered through that storm eventually regained their pre-crash wealth and even surpassed previous levels. However, such rapid recoveries are more the exception than the rule. This time, the recovery could take a significantly longer period, if it occurs at all. For example, the Japanese stock market crashed in 1990, and it wasn't until 2024, the 24th year after the crash, that it finally returned to its previous peak. During that interval, an entire generation of Japanese investors watched their wealth evaporate, unable to rebuild what was lost. A similar scenario could transpire in the United States, especially if the economic crash proves severe enough and the recovery process stretches over several arduous decades. The wealth built through housing will also evaporate, trapping millions of Americans in homes they can no longer afford to sell without incurring heavy losses. This situation will not only limit mobility, but will also diminish the potential for economic recovery by locking homeowners into depreciated assets, house values that have fallen well below their mortgage balances, making it financially unviable to move or downsize. The job market, particularly for young people entering the workforce during and after this downturn, will become incredibly brutal. Graduates in the years 2026 and 2027 will face an almost non-existent number of entry-level positions. Companies, hesitant or simply unable to expand their payrolls, will halt hiring altogether. When jobs are available, they will be highly competitive, with hundreds or even thousands of applicants vying for each opening, making it a battle to secure stable employment. As a result, this generation will likely embark on their careers 5 to 10 years later than historically typical, which will significantly suppress their lifetime earnings. Extensive studies examining those who graduated into the 2008 recession have shown that their earnings across their entire careers tend to be lower than those of their peers who entered the workforce a few years earlier. The coming economic collapse is expected to be even more severe, implying that the long-term scars it leaves will be deeper and the path to recovery even longer. Small businesses, the backbone of local economies, will be among the hardest hit. As consumer spending dries up and credit becomes increasingly unavailable, countless small retail shops, family-owned service providers, neighborhood restaurants, and local entrepreneurs will be forced to shut down, potentially in the hundreds of thousands. While larger corporations with access to extensive capital markets may survive, many smaller enterprises will not make it through the storm. This consolidation will lead to an economy that is increasingly dominated by a handful of vast corporations, while small businesses, which traditionally foster innovation and competition, play a diminished role. Consequently, the economy will become less dynamic, less competitive, and less capable of adapting to new challenges. Meanwhile, the strain on social safety nets will be immense. As unemployment surges to unprecedented levels, government revenues will plummet due to declining tax collections, leaving social services and welfare programs overstretched beyond their capacity to support those in need. The government, caught between rising demands for assistance and diminishing funds, will be forced to make critical spending cuts. These austerity measures will be implemented even as the numbers of unemployed and impoverished people continue to grow, creating a vicious cycle of increasing hardship and shrinking resources, a situation that threatens to destabilize social order and exacerbate existing inequalities. In summary, the impending economic crisis promises to reshape the landscape of personal finance, employment, and societal stability in profound ways. It will challenge millions of Americans at every level of economic security and life plans, ultimately forcing a reevaluation of financial strategies, career trajectories, and government priorities for years, perhaps decades, to come. The unfolding crisis is not just economic, but deeply humanitarian as well, creating a dire situation where the most vulnerable segments of society, such as the elderly, disabled individuals, and those without jobs, find themselves facing drastically diminished support precisely at the moment they need aid the most. This dual catastrophe, combining both economic collapse and humanitarian suffering, leads to a complex and destabilizing environment where social safety nets are fraying and hope for recovery diminishes. As economic systems crumble, political instability inevitably takes hold, further aggravating the situation. History offers a sobering reminder. During the tumultuous years of the 1930s, widespread economic despair in Europe spurred the rise of extremist political movements. People, desperate for solutions, became increasingly susceptible to the promises of authoritarian leaders who capitalized on their vulnerability. The hyperinflation that gripped Germany during that period played a significant role in paving the way for Adolf Hitler's ascent to power, illustrating how economic tumult can directly influence political trajectories. In the present, the United States is not immune to these dangerous dynamics. When a nation's economy disintegrates, it often results in a surge of political upheaval, fueled by the collective frustration and hopelessness of its citizens. Historically, when people lose everything, jobs, savings, homes, they seek someone to blame for their suffering, and they gravitate toward leaders who make radical promises to solve their problems quickly. The economic downturn anticipated in the year 2025 is expected to reshape the American political landscape in unpredictable, yet fundamentally destabilizing ways. Now, one might ask, why is the crisis forecasted for 2025 potentially worse than both the stock market crash of 1929 and the financial collapse of 2008 combined? The answer lies in the unique convergence of three catastrophic bubbles which, in these past crises, existed separately, but now are all bursting simultaneously. First, there are the stock market bubbles reminiscent of 1929, where equities are grossly overvalued. Second, the housing and credit bubbles of 2008, built on unsustainable debt levels, are now intertwined with a rising debt burden of the government, a crucial difference from previous crises. This government debt bubble is extraordinary, more substantial than in any previous financial turmoil. In the 1920s, only the stock markets crashed, and only about 10% of Americans experienced direct consequences. During the 2008 crash, the collapse of the housing market was the primary trigger, but the government relied on borrowing and money printing to stabilize banking institutions without triggering accelerating inflation. However, in 2025, everything is collapsing at once: stocks, housing markets, consumer and government debt, while the traditional tools available to policymakers are no longer effective. The Federal Reserve cannot simply lower interest rates to zero because elevated inflation levels persist, making such a move unattainable. At the same time, printing unlimited money is no longer viable, as the recent surge in money supply already led to the worst inflation seen in 40 years. Meanwhile, the government's capacity to bail out everyone is severely constrained, given that national debt has ballooned to a staggering $36 trillion. The multiple warning signs I have elucidated, ranging from an inverted yield curve to Warren Buffett's tendency to hoard cash, are not mere speculation. They are concrete facts that are presently unfolding. The inverted yield curve, which has historically served as an accurate predictor of recession since 1950, indicates that a downturn is looming within the next 3 to 9 months. Additionally, signs such as failing regional banks, the collapse of commercial real estate, rising delinquencies on record-high consumer debt, increasing unemployment, and insider selling at levels that typically precede market crashes all point to an imminent economic storm. Every indicator currently flashing red suggests that the time frame for this downturn is aligning, especially with the yield curve normalization observed in September of 2024. Typically, a recession follows within 3 to 12 months after such signals appear, placing the potential onset somewhere between December of 2025 and September of 2026. Moreover, the peak period for refinancing commercial mortgages is projected for 2025 and 2026, increasing vulnerability in the financial system. Defaults on credit card debts are also accelerating, adding yet another destabilizing element. The trigger for this impending collapse could materialize at any moment, and once it does, the cascade of failures will be unstoppable. This is not merely a forecast or guesswork, it is pattern recognition grounded in historical cycles. The same warning signs, the same economic behaviors, and the same vulnerabilities that preceded the stock market crashes of 1929 and 2008 are present now, only amplified and more extreme. When the crash finally occurs, stock prices could plummet by anywhere from 65 to 80% from their peaks, worse than the 90% declines experienced in 1929 and 1929, but likely faster and more concentrated in its impact. Bonds are also expected to drop significantly, ranging from 35 to 50%, a decline that did not take place during the previous crashes. Real estate prices will also suffer a severe decline, between 40 and 60%, dragging well below the depths reached during 2008. Unemployment rates could skyrocket beyond 15%, leading to widespread joblessness and economic hardship across the nation. In summary, the current convergence of multiple economic crises, coupled with historic vulnerabilities and systemic weaknesses, presents a situation far more perilous than past financial collapses. The magnitude of these combined factors points toward a period of profound upheaval, with ramifications that will reshape the economic and political fabric of the United States for years to come. The process of economic recovery from this current crisis is unlikely to follow a quick and straightforward path, unlike the recovery after the 2008 financial turmoil, which took roughly 5 years. Instead, it is now projected that the road to stability will span at least a decade, possibly extending anywhere from 10 to 20 years or even longer. This extended timeline is largely due to the fact that the Federal Reserve has exhausted almost all of its traditional policy tools. It no longer possesses the necessary mechanisms to effectively stimulate the economy or to counteract severe downturns. Similarly, the government's capacity to borrow and implement expansive fiscal measures has been severely constrained, leaving fewer options for active intervention. The prevailing conditions have led to what many now refer to as the everything bubble. The term aptly captures the phenomenon whereby nearly every asset class, whether stocks, bonds, real estate, or commodities, has been inflated to unsustainable levels. Because all these markets are simultaneously overvalued, any correction tends to trigger a cascade effect, causing a multitude of assets to tumble together. This interconnectedness means there is no safe haven or hiding place within the financial system when the inevitable adjustment occurs. Historically, we have observed significant market crashes that seemed almost unimaginable at the time. Catastrophic events that we believed would never recur because of lessons learned from previous crises. These episodes, recorded in financial history books, were thought to be anomalies, the result of specific circumstances that would not repeat. Yet, what is approaching threatens to replicate these devastating crashes on an even more violent and widespread scale. The scale of this potential collapse is such that it could shock and astonish even the most skeptical observers, including those who believe that the crisis of the past was a one-time event. The mathematical inevitability of such a severe downturn is rooted in several fundamental factors. The unsustainable levels of unpayable debt accumulated across nations and corporations, the overvaluation of key assets that are detached from their intrinsic values, and the depletion of policy options available to governments and central banks. These conditions set the stage for a financial upheaval that metrics and economic models suggest is unavoidable. The forecast is clear: an economic crash is on the horizon. The only remaining question that individuals and entities should consider now is whether they are adequately prepared to face the upheaval when it finally arrives. Proper readiness could mean the difference between weathering the storm or being overwhelmed by its force.